Every major market crash feels sudden to the public. One morning, people wake up and discover that their savings have shrunk, their investments have collapsed, and their confidence in the system has evaporated. But for billionaires, the crash never arrives unexpectedly. They see the warning signs long before the headlines appear. Not because they can predict the future, but because they recognize a repeating pattern. The truth is unsettling. Before every historic crash, from the devastation of 1929 to the shock of 1987 to the global panic of 2008, and now the uncertainty surrounding 2025, the ultra-wealthy quietly make the same three moves. Three trades. Three shifts that happen almost like clockwork. Today, we're going to uncover those trades. We'll travel through nearly a century of financial history, connect the dots, and reveal the playbook the ultra-rich still use today. By the end of this video, you will see the crash cycle in a completely new way and understand why 2025 is raising so many eyebrows among experts. Every crash begins with a silent exit, not a dramatic sell-off, not chaos. Just a slow, steady shift out of risky assets and into pure liquidity. The public never notices when it happens. And that's exactly why it works. In the months leading up to the crash of 1929, the wealthiest industrialists quietly began pulling their money out of the stock market. Newspapers at the time were celebrating record highs and unstoppable growth, but behind the scenes, insiders were tightening their positions, raising cash, preparing for what the average person wasn't willing to see. A similar pattern appeared in 1987. As the market soared, institutional investors gradually built positions in safer, short-term financial instruments. To the everyday trader, the rally looked strong. But deep in the financial system, risk indicators were flashing red, and the people with access to those indicators did what they always do. They stepped aside before the crowd realized the danger. In 2008, the process repeated almost perfectly. Long before Lehman Brothers collapsed, the richest investors had already begun stacking cash. They watched credit tighten, they watched mortgage data worsen, and they prepared for impact while the world was still optimistic. And now, as we approach and move through 2025, the same quiet retreat has been unfolding. High-profile investors have increased their cash reserves, reduced speculative exposure, and positioned themselves for flexibility. To them, liquidity is not a retreat, it is ammunition. It is the power to move when the world freezes. This is always the first trade. Get liquid, stay patient, and wait for the moment when others no longer have that luxury. Once the wealthy position themselves with the liquidity, they make their second move. They establish protection. Not emotional protection, but financial insurance. The kind that grows stronger when the world grows weaker. During the late stages of 1929, some of the savviest investors quietly shifted into safer, more stable assets. They were laughed at during the final days of the bubble, but they weren't chasing quick profits. They were building a shield. Before the 1987 crash, that shield took the form of government bonds. As automated trading models amplified market risk, the wealthiest investors moved into assets that held value regardless of panic. In 2008, the hedge was more sophisticated. Instead of simply fleeing to safety, the ultra-rich hedged against volatility itself. They positioned themselves to benefit directly if the market fell apart, and when the crisis unfolded, those hedges exploded in value, offsetting losses and sometimes even producing massive gains. Today, in the run-up to 2025, the crash hedge has evolved again. The defensive positions are more diverse, more technologically driven, and more calculated. Some protect against volatility. Some aim to stabilize wealth. And some are designed to take advantage of sudden drops. But the purpose remains identical. When the crash arrives, the hedge keeps the wealthy from falling with everyone else. This is the second trade. Build the lifeline before the ship hits the storm. When the crash finally arrives, when fear spreads faster than logic, a shift happens. The same billionaires who stepped aside during the buildup return to the market with relentless precision. This is the third and most profitable trade, buying when everyone else is selling. After the devastation of 1929, while the public ran from the markets, wealthy investors began quietly purchasing distressed assets. Entire industries were bought for fractions of their previous value. Those who had prepared earlier ended up owning the future of American industry. In 1987, after the Dow collapsed in a single day, valuations were suddenly cheap. The smartest investors doubled down on strong companies whose fundamentals had not changed. Only their prices had. When the recovery came, their positions surged. In 2008, the opportunity was even greater. During the darkest days of the financial crisis, some of the most legendary investments in history were made. Billions were poured into banks, real estate, energy, and distressed debt. What looked like chaos to the public looked like a clearance sale to those who had prepared. And if 2025 brings another correction, the same pattern is already forming. Cash is waiting on the sidelines, defensive hedges are in place. The ultra-rich are simply waiting for the moment when panic pushes prices to levels they consider irresistible. This final trade is the reason billionaires don't fear crashes. They capitalize on them. When the world is frozen in fear, they move with clarity. When others sell out of panic, they buy based on discipline. And in the aftermath, their wealth multiplies. Across nearly a century of data, one uncomfortable truth remains. History changes. Technology changes. The economy transforms. But human behavior does not. Fear, greed, and panic repeat across generations, and billionaires have learned to navigate those emotions, not fall victim to them. Every crash tells the same story. First, they rotate into liquidity. Then they protect themselves with calculated hedges. Finally, when fear reaches its peak, they buy what the world is throwing away. This simple pattern has silently built some of the largest fortunes in history. If you found this breakdown fascinating, make sure to like, subscribe, and hit the bell because on this channel, we uncover the strategies that shape the world long before the headlines do.